Hello, everyone, and thank you for joining us. My name is Samantha Johnson, and I am the Assistant Director of Alumni Engagement at the University of Colorado Boulder's Leeds School of Business. Leeds is a top business school offering undergraduate, MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. We're excited to have Professor Thibodeau presenting on decreasing the interest rate to stimulate investments, effective or not, for today's webinar. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask, please send those questions through your chat interface. I will monitor questions as they are submitted, and they will be answered throughout the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants later today, along with a survey link. Now, I'd like to introduce today's speaker, Professor Thibodeau, Global Real Estate Capital Markets Professor at the Leeds School of Business and Academic Director for the CU Real Estate Center. Please note that you can download his full bio in your handout section of the attendee panel. He teaches courses in real estate finance and investments, real estate economics, and real estate risk management. Professor Thibodeau has published 38 papers in nationally recognized refereed journals, and his publications have accumulated over 4,000 citations in academic literature. He serves on the technical advisor board for Zillow.com and has consulted for organizations ranging from the Rocky Mountain Institute and Fidelity National Information Solutions to Fannie Mae, the Urban Institute, and the U.S. Department of Housing and Urban Development. Welcome, Professor Thibodeau, and thank you so much for being here.
Thank you, Sam. I'm glad to be here. And I want to thank everyone who's taken the time out to listen to my current research project, decreasing the interest rate. So, historically, this has been a topic that goes back decades, and the question is, does reducing the interest rate stimulate investments? And there are two theories that compete with each other for that relationship. The traditional, or shall we say, neoclassical theory of investment says that reducing the interest rate reduces the cost of capital, particularly the cost of debt financing, and as a consequence, reducing the interest rate will stimulate investments. More recently, there's been an options-based theory that's been proposed, and the idea behind the options-based theory is that reducing the interest rate lowers the cost, the opportunity cost of waiting or postponing investment, and consequently can effectively reduce aggregate investment. And so I guess a third question that we address in this paper is, are there other variables that influence the relationship between interest rates and investments? And we look at this question using real estate data on capital expenditures that we have from NCREIF. And so NCREIF, the National Council of Real Estate Investment Fiduciaries, is a member-owned organization that reports their investments to NCREIF, and they report things like purchase prices, operating income and expenses, and transaction prices when properties are sold. NCREIF has been reporting this data since 1977 and has roughly about 40,000 properties over the last several decades. We take this data, and since the information includes capital expenditures, we can actually look at whether or not capital expenditures are responsive to changes in interest rates. We also look at the relationship between cap rates and investments. The notion here is, as cap rates go down, property values go up, and does that either encourage or discourage capital expenditures in income-producing properties. And in order to answer that question, we develop a special series of cap rates that we call constant quality cap rates. And the idea is your typical cap rate is based on an average of all properties of a given type, like office, retail, apartment, or industrial, that sell in a particular quarter. So if you look at, for example, the Real Capital Analytics cap rates, they'll take a metropolitan area like Denver and look at all of the office properties that have sold and calculate average cap rates. And they do this each quarter. The issue for us is we would like to understand what happens if you hold the attributes of the properties that are included in the cap rate calculation constant over time. So when cap rates change over time, the issue is that because of changes in the attributes, that is, newer properties are selling more rapidly, or bigger properties are selling more rapidly, or is it because the rate at which those future benefits get capitalized into value is changing? And we are fundamentally more interested in the latter. And the analogy here is how you measure house price changes over time. And so basically a repeat sales house price index calculates the average change in the price of the same house that sells in two different periods. So our cap rates basically measure, our cap rate, constant quality cap rate index basically measures how cap rates for the same property change over time. So here's a picture of the relationship between gross private domestic investment and yield on 10-year treasuries. We actually look at both yield on 10-year treasuries and yield on 3-month treasuries as our metric for interest rate movements. And so the red line reports the yield on 10-year treasuries, and you can see that the yield has gone from under 2% over the last 7 or 8 years to about 15% in 1980. And then the blue line represents aggregate gross private domestic investment back to 1962. And you can see there are periods where gross domestic private investment is increasing with the interest rate, and you can also see periods where gross private domestic investment is decreasing with the interest rate, which is inconsistent with the notion that lowering interest rates will increase investments. And more particularly, if we focus on the period since the beginning of the Great Recession, from 2007 to 2009, both interest rates and investments were decreasing. And then there were periods, since say 2011, where interest rates have been declining and gross private domestic investment has been increasing. So the signal is kind of mixed. And what we try to do in this paper is sort that out. On the cap rate side, this diagram represents the relationship between the average cap rate. So that's the national average cap rate for all the property types reported by Real Capital Analytics going back to 2001, which is the earliest time that we have that data, and total transactions volume for commercial real estate, also going back to 2001. And you can see going back to from 2001 to the beginning of the financial crisis, 2007, total sales volume were increasing pretty dramatically as the average cap rate was falling. And then during the financial crisis, total sales volume plummeted initially while cap rates increased, and then while cap rates decreased from say 2010 to the current period, investments were increasing. So again, there isn't a consistent sort of story to just pull out of this chart or this data. The next chart basically numerically represents what you saw in the previous chart. So it looks at the average cap rate by property type for the 2001 to 2017 period. And so the lowest average cap rate, both measured in terms of the mean or the median, the lowest mean cap rate was for apartments, about 6.6%, and the highest cap rate was for industrial properties, about 7.8%. In terms of volatility in cap rate, the retail properties had the lowest volatility with a standard deviation of about 0.7%, while office properties over this period had the highest volatility with a standard deviation of about 1.1%. Over the same period, the average yield on 10-year treasuries was about 3.4. So consequently, the average spread between apartment cap rates and yields on 10-year treasuries was about 320 basis points, while the average spread between industrial properties and yields on 10-year treasuries was about 440 basis points. So to our research, we began with all of the data that NCREIF provided. So they provided data from 1977. We actually have been working on this paper for a number of years. Our data stops in 2014. And NCREIF began reporting capital expenditures in the third quarter of 1997. And they report capital expenditures in two ways. One, they report building expansions, which are tangible improvements to the property that result in an increase in leasable area. And they also report building improvements, which are tangible improvements to the property not attributable to tenant space. And we actually look at both of these in this research. So over this 1997 to 2014 period, we have about 17,629 properties where we can see both the acquisition and the disposition rates for the same property. And then we use these to compute cap rates for a national average constant quality by property type. And we then use, we compute metropolitan area specific cap rates for 243 metropolitan areas. And I'll go into a little bit more detail on how we construct that in just a minute. So here's a summary of our data. We have information for over 3,000 apartment properties, over 4,200 industrial, 3,000 office, and 1,700 retail for 243 metropolitan areas across the U.S. The investors, or I should say the institutions that report their information to NCREIF are places like BlackRock, Citigroup, TIAA-CREF, New York Life, Invesco, and so on. And we have information on 105 of these different institutional investors. The average property holding period for this data was about 5 years. So why constant quality? How do we calculate these? Well, if you look at how you calculate a constant quality house price index, you basically relate the ratio of, or the rate of appreciation in the property over the holding period to the quarters over which the property is being held. And statistical analysis allows you to attribute that total holding period appreciation to individual quarters. And so we basically follow the same procedure that we use to calculate a repeat sales house price index, except we use repeat sale cap rates. And so we relate basically the ratio of cap rates, or the change in cap rates over an entire holding period, to the individual quarters during the holding period. And then we anchor that initial cap rate to the beginning of the analysis period, which is the third quarter of 1997, the quarter that NCREIF started reporting capital expenditures. And then we apply the changes in cap rates by quarter and by property type to that initial anchoring. And we end up with a time series of quarterly constant quality cap rates for the 1997 through 2014 period. And so how do we do this? And so we have acquisition cap rates for about 24,510 properties. And that's where, of those, we observe the actual transaction price, the initial transaction price, and net operating income. And so that's the net operating income is the NOI for the subsequent 4 quarters for about 15,000 properties. And then we estimate the cap rate for properties where we don't have observed transaction prices, we used the reported appraised values for about 9,000 properties. And then we have disposition cap rates for about 20,000. And we have observed disposition cap rates for about 10,000 of them. And then we estimate the transaction price using appraisals for about 10,000. And so this is the relationship for our national constant quality cap rates, and we're comparing our constructed cap rate to the Real Capital Analytics national cap rate. And you can see that, you know, they're not the same, although they're pretty close. There's a little bit more volatility in the constant quality, so we're basically keeping the attributes of the properties that transact constant over time, as opposed to simply reporting the attributes of the properties that happen to sell in each quarter. For other property types like apartments, we get a pretty significant difference. And so we're basically anchoring in 1997 and then going forward. Unfortunately, the Real Capital Analytics data just doesn't go back that far, so we're able to sort of do the comparison from 2001 going forward. And the constant quality apartment cap rate is uniformly lower than the actual Real Capital Analytics reported cap rate for virtually the entire period. When it comes to the metropolitan area cap rates, there's not enough properties to use the same repeat sales method to estimate an MSA specific cap rate. And so we estimate MSA specific constant quality cap rates by starting with the national index that we constructed, and we relate the MSA specific cap rate to the national index using basically two parameters. A drift parameter, that is the rate of change, and the sensitivity, how sensitive is changes in the local MSA cap rate to the national cap rate. And we do this estimation for all metropolitan areas that have at least 15 properties, and that's where we ended up with the 243 metro areas. We also do this analysis by property type. And so at the MSA level, here's a comparison of the office cap rate for the city of Denver from 2001 to 2014. So the blue line on top represents the Real Capital Analytics reported cap rate, and the red line, the line on the bottom, represents cap rates for our constant quality Denver cap rate. And you can see that the constant quality does exhibit a little bit more variance, but it tends to track the reported Real Capital Analytics cap rate fairly well. So maybe now is a good time to take questions. Does anybody have a question?
Sure. So as a reminder, you can submit your questions through the chat interface. So we'll give everyone a few seconds here. All right, Professor Thibodeau, it doesn't look like there are any questions at this time.
Okay, that's fine. So we basically are interested in trying to identify the relationship between interest rates and capital expenditures on income-producing properties. And so essentially, our model relates the likelihood or probability of making a capital expenditure, and we use both the improvement or the expansion definitions reported by NCREIF to interest rates, and we separately look at short-term rates or yields on 3-month treasuries, as well as yields on 10-year treasuries. We incorporate a variable on interest rate squared to accommodate a potential nonlinear relationship between interest rates and the likelihood of making a capital expenditure. We also include variables that we think may influence that relationship. And so we include a variable on expected rent growth. So we have CBRE rent data for all of our metropolitan areas, and we compute the actual rent growth in the 4 quarters that are subsequent to our cap rate on the notion that investors can on average, anticipate rent increases in their market, and do they respond to those expected increases in rent by making additional capital expenditures? We also look at the volatility in that rent growth. And so we calculate the standard deviation in those observed rent growth numbers for the 4 quarters subsequent to the cap rate calculation, on the notion that the more volatility or the more uncertainty there is in that expected rent growth, the less likely an investor might be willing to make a capital expenditure. And then we look at both an interaction between rent growth and volatility. So positive rent growth would provide an incentive to invest. More volatility would provide a disincentive to invest. And which of those two effects is likely to dominate? And then because cap rates or capital expenditures tend to take a long time, they would spill over from quarter to quarter. So if there's a capital expenditure in one quarter, there's a good chance that there's going to be a capital expenditure in the subsequent quarter. We try to control for that by including whether there was a capital expenditure in the previous quarter. And we also want to know if investors are more likely than not to make a capital expenditure prior to a sale. And so we also control for that. And we also control for the location, the MSA the property is located in. And then we include investor fixed effects, which means we control for who's reporting the data. Is it TIA-CREF? Is it Invesco or whoever else? I'm going to spare you the point estimates, but the empirical results indicate that interest rates have a positive effect. And so higher interest rates mean more investment, but you really can't interpret that variable separately because we have a variable interest rate squared, and the square of the interest rate is negative. And I'll put up a graph here that helps with the interpretation of the relationship between interest rates and capital expenditures. Expected rent growth is expected to have a positive effect on the likelihood of making a capital expenditure. Volatility in that rent growth is expected to have a negative effect. So more volatility, more uncertainty, less likely to invest. The interaction indicates that the volatility in rent growth has a greater influence on the likelihood of investing than the expected rent growth. So investors are more concerned with uncertainty in that expected rent growth. And then if there is, or if there was a capital expenditure in the previous quarter, is there likely to be one in this quarter? And the answer is yes. And then if there's a subsequent sale, that reduces the chances of making a capital expenditure in the previous quarter. And the relationship is pretty consistent across both measures for interest rates. So using either the 3-month US Treasury or the 10-year US Treasury, you get basically the same results. And these results are all in the paper. If anybody's interested in the paper, just contact Sam and we'll make sure and get a copy of the paper to you. So here's what it looks like graphically. And so this is purely the relationship between interest rates and the probability of making a capital expenditure. So interest rates is on the horizontal axis and the likelihood of making a capital expenditure is on the vertical axis. And the interest rate depicted in this graph is yields on 3-month US Treasuries. And so if you look at, say, a rate of about 2.4%, for interest rates that are higher than 2.4%, that's the sort of traditional investment theory that says reducing the interest rate is going to increase the likelihood of making a capital expenditure on commercial properties. But if you look to the left of about 2.4%, what it shows is that decreasing the interest rate is likely to reduce the probability of making a capital investment. So there's clearly other things going on in addition to interest rates that are going to stimulate or encourage capital expenditures in commercial property. And then when you look at the yield on 10-year treasuries, you get a much more dramatic effect. And so here the break-even interest rate is about 3.4%. And so for rates higher than 3.4, you get that traditional relationship between investment and interest rates. That is, reducing the interest rate is likely to stimulate or increase the probability of making a capital expenditure, while for interest rates below about 3.4%, reducing the interest rate tends to disincentivize or discourage, reduces the probability of making an expenditure. So what about those other variables that we think may influence capital expenditures on income properties? So the first that we're going to look at is expected rent growth. And you can see, and again, this was measured using the CBRE data. So we're looking at the subsequent 4 quarters, and we have expected rent growth going from about -10% to about 18%. And you can see that the probability of making a capital expenditure increases when expected rent growth is higher. But the probability of making a capital expenditure is significantly lower when there's more volatility or uncertainty in that expected rent growth. And I'm going to flip back here for a second. The scale, the probabilities on the vertical axis on the left-hand side are the same in both graphs, and you can see that the rent growth volatility graph or line is significantly more steep than the rent growth line. And as a consequence, investors are more responsive to uncertainty in that expected rent growth than they are to that rent growth to begin with. And I guess here's another opportunity for questions.
Sure, we'll give everyone a few seconds here in case anyone has any questions on what we've been discussing thus far. All right, and it looks like you've got some great information you're providing us. No one has any additional questions at this time. Oh, sorry, nope, one just came through. So the factors that you were just discussing, Professor Thibodeau, are those correlated at all between volatility and rent growth?
Sure they are. And so basically what I'm doing is holding other things constant in these graphs just to get a basic understanding of what the relationship is between those two. If I could do something in, say, 3 dimensions that looks at the interaction of those things, but it's hard to do on a PowerPoint slide. But the answer is, of course, they are.
Okay, thank you. All right, and it looks like we don't have any other questions at this time.
Okay, and so the second thing and the related thing was, what's the relationship between cap rates and investments in income producing properties or capital expenditures in income producing properties? And so we use our constant quality cap rate measure and interest rates in a very, very similar model. So we relate the odds of making a capital expenditure to our cap rates, holding the spread we're holding the spread over yields on 10-year treasuries constant. So this is basically holding interest rates constant. What's the relationship between investment and cap rates? And then we have our expected rent growth, our volatility in rent growth, the interaction between these two, lagged capital expenditures and a subsequent sale. And essentially what we find is, and here we have cross-sectional data for our 243 metropolitan areas. And so we find places that have lower cap rates have smaller odds of making a capital expenditure. And that's true for both yields on 3-month treasuries and 10-year treasuries. Places that have more expected rent growth have a higher likelihood of making capital expenditures on income properties. Places that have more volatility have lower odds of making a capital expenditure, and the uncertainty or the volatility parameter basically dominates the relationship between expected rent growth and uncertainty. And then we use the same lag capital expenditure and subsequent sale variables. And here's the relationship between the probability of making a capital expenditure and cap rates. And so this is more of a cross-sectional analysis because we have 243 metropolitan areas. And so basically what you can see is as cap rates increase, the likelihood or probability of making a capital expenditure decreases, and it's pretty significant. Okay, so to conclude, capital expenditures on income properties are a backward bending function of interest rates. And so over the 1997 through 2014 period, when yields on US Treasuries were greater than 3.2%, the cost of capital effect dominates the relationship between rates and capital expenditures. When yields were less than 3.2, the real options effect dominates the relationship between investments and interest rates. But the relationship is also influenced by things like expected rent growth and volatility in that expected rent growth. And the volatility effect dominates the rent growth and volatility effect. Making a capital expenditure in one quarter increases the odds of making one in the next, and making a capital expenditure reduces the odds of selling a property in the next quarter. And last but not least, the lower the cap rate, or that is the higher the property value, the greater the odds of making a capital expenditure. Okay, questions?
All right, so Professor Thibodeau, we have a question here. Do you expect the Denver market is representative of others, or would the result change if the analysis was done in a different market?
Okay, so all of this analysis was done using national data. So this is representative of what's happening in 243 metropolitan areas across the US, including Denver, but it's not just Denver.
Okay, thank you. Do you expect that if you were to look at just the data in the Denver market, that it would be similar to others, or do you think that you would see some significant changes?
Oh, I think it would be very similar to others.
Are there any markets in the country that you think would stand out from the general results that you got?
That's a good question. Honestly, I haven't looked at the data, but it's something that I could do. So basically what you're asking is sort of what places kind of follow the general pattern, what places are kind of unique. And honestly, off the top of my head, I don't have an answer for you, but I could look into the data.
Mm-hmm. So, and then also, as the 10-year T's approach 3.4%, do you see this as being a dominant factor in broader economic growth?
So I think, honestly, I think what this analysis shows. So first, let me say that this is very narrowly focused on the relationship between capital expenditures on income producing properties and interest rates. I think we need to sort of make inference about the broader gross private domestic investment market with a little bit of caution. But having said that, I do think what we've shown is the relationship between interest rates and investment is way more complicated than both theories of investment. That is, the traditional theory is sometimes right and the options model is sometimes right. And the relationship depends on things other than interest rates. And essentially, a main driver is investors' expectations of future gains, as well as the uncertainty associated with those future gains. And so I think we've opened up a line of research that I think we should pursue outside the world of real estate to get a better understanding of what really dominates the effect.
Yeah, that's really interesting. Yeah. And also, what do you forecast as we start approaching 4% on the 10-year?
Well, again, I honestly don't think interest rates are going to return to their historic levels. Um, and I think that investment is going to be driven by expectations of return rather than the cost of capital. So let me explain. I don't think interest rates are going to return. So if you go back and you look, say, over the last quarter century, the average sort of interest expense or interest rate that the U.S. government's been paying on the national debt has been about 5%. Over the last decade, since just before the financial crisis, it's been closer to, say, 2%. And the national debt has gone from something like 8 trillion to 20 trillion. We are actually paying less interest now than we paid before the great financial crisis. And that's because it's cheaper to finance 20 trillion at 2% than it is to finance 8 trillion at 5. I think if interest rates went back to their sort of more historic levels of 5, we'd go bankrupt. I don't think we have the capacity to do that. And so I see interest rates going up a little bit, and the Fed is going to sort of kind of inch interest rates up a little bit, but I just don't see them going back to historic levels anytime soon. And so having said that, if there is not going to be much volatility in the rates themselves, investment decisions are going to be driven by other things, and those other things are basically the expectation of investment returns and the uncertainty associated with those returns.
Huh, that's interesting. Thank you for sharing all of that. Um, have you, in discussions that you have had in the classroom around this, have there been any big takeaways or any notable observations with conversations that you've had with students around this topic?
Uh, I think people are surprised that the real options sort of theory uh, is real, and investors sort of need more than a reduction in the cost of capital to uh, make investment decisions. So that's been pretty encouraging.
Sure. So we have time for one or two more questions if anyone has any other questions for Professor Thibodeau. So Professor Thibodeau, one more question for you. As individuals are exploring making, as individuals are exploring the opportunity of an investment based on your research, is there something that was surprising that individuals should think about, that was most surprising in what you found?
Honestly, no. Like most things, the answer is never black and white, and there's usually more than one thing that influences individuals' decisions to make investments. I would say, the most important thing is to get an accurate assessment of the market and try to forecast what the expected investment return is, and make good judgments based on that.
All right, thank you. And also, do you see an opportunity for the difference between interest rates and the rates of return to compress further?
Yeah, good question. Um, I think as we're in the middle. I think somebody asked me, a couple weeks ago, what inning are we in the current cycle? And
That's a good question.
yeah, I think we're probably in terms of this national real estate cycle. I think we're probably in the fifth inning, and um, I honestly don't see major risks coming from the property market side. That is an oversupply. Although there are certain property types in certain markets that are probably oversupplied, but nationally, I don't see a particular property type being oversupplied. Um, and I don't see huge risks coming from the capital market side for reasons I just explained. I don't. Yes, interest rates are going to go up a little. I don't think they're going to go up a lot. I honestly think the biggest risks that investors are facing, and not just real estate investors, but all investors, I think the biggest risk is the geopolitical risk. There's a lot of uncertainty coming out of Washington. Threats of tariffs and all kinds of sort of major disruptions in international economies that could have significant effects on investment opportunities here. And so it's really, those kinds of risks that are virtually impossible to sort of forecast and predict that are likely to have the biggest effect on people's investment decision making.
Hmm. Yeah, there are a lot of factors at stake. Another question for you, and I'm sure I have this question for you as well. So given that we're in the fifth inning, do you think what are your thoughts around now being a time to purchase various real estate, so apartments, industrial, I guess residential versus commercial properties? Is there a difference with that as well?
So, there isn't a sort of global answer to that question. It really is very market specific. So, for example, if you're talking about Boulder's always a good time to buy.
Yes.
Okay, if you're talking about a high-end multifamily in Denver, there could be a bit of an oversupply there. So it really is market and property type specific. There isn't one answer for all property types and for all places. And what that requires is you do your due diligence and you take the time to find out, okay, so where's the demand coming from? And is that likely to continue? And what does the supply look like? And what does the pipeline look like? And you have to understand if there are real opportunities for decent returns on your investments.
Great, thank you. And do you have any suggested resources for individuals to go out and seek out those answers?
Well, I think a basic understanding of real estate economics and real estate finance is a good place to start. And so the book by Brueggemann and Fisher on the finance side is a good place to start. In terms of market data, a number of the brokerage houses put out market reports for different property types, and those and your local realtors, if you're looking at owner-occupied housing, puts out basic reports on transactions and days on the market and prices and things like that you should consider very seriously when making any purchase decision.
Wonderful, thank you. Well, and I think that is all of the questions for now. So I do want to say thank you so much to everyone for joining us for today's presentation. And Professor Thibodeau, again, thank you so much for all of this great information and conversation. To view upcoming webinars and request previous recordings for past webinars, please visit our website at www.colorado.edu/alumni/webinars and have a great rest of your day and go Buffs.